Hey guys, welcome to my channel Deep Take Finance, and in this video I would be discussing the topic window dressing. So let's get started with it. Introduction to window dressing. So what exactly window dressing is? It is the act of manipulating the correct picture of financial statements of a company to show a better position than actual position. So many a time what happens is that the companies are involved in a sort of window dressing of their financial statements. They know that they have to show better position in order to attract the interest of stakeholders. Now these stakeholders could be creditors, supplier, government, shareholders, or any potential investor. So in order to show them that their business is doing quite well over the years, sometimes they manipulate their financial statements, and this act of manipulation is referred as window dressing. Now this is usually difficult to detect because it involves higher management with it. So many a time higher management themselves are involved in this sort of manipulations of their financial statements, because to gain the favors, to attract all the stakeholders, and if the business is not doing well over the years, they actually do these things. Now we will talk about it, whether it is right or wrong, whether there should be legal proceedings against it or not. But somewhere the basic crux of this is that manipulation of financial statements is done by the company involving the higher management to show a better position of the business. Now, as I mentioned, this is mainly done for attracting potential investor by showing a good financial position of the company, and also to save on the taxation by the government. So let's see how it happens. Now, sometimes we refer window dressing as creative accounting also. So let me first read for you. Window dressing of financial statements is also referred as creative accounting and is considered as an art until and unless it goes against any of the set rules, standard or law to be followed. Hence, it is considered legal in such manner. So, when we are talking about manipulating data of financial statements, if it is not going against any rule, standard or law, it would be considered legal and no action would be taken against it. But and that is why it is also referred as creative accounting, because you're not putting any wrong data, but you are showing the data in such a way that you are manipulating the statements in order to gain benefits from it. So many times it is referred as creative accounting as well. But if we talk about it, there is no legal proceedings as such if it is in accordance with the rules and standards. But is it ethical? So window dressing is not at all ethical because it manipulates the data and does not provide a true and clear picture of the business, which is like cheating to your stakeholders who hold on their interest in company's growth and position. So you are manipulating the data, you are not showing the clear picture of your business. So what you are doing, you are cheating with the stakeholders who are trusting on you and thus getting involved in your business. So is it ethically correct? It is not ethically correct. Whereas if it is in accordance with rules and regulations, it is legally okay to do. And this is adopted by many business organization. What they sought to do, they manipulate their data when they have to present their financial statements, and if their business is not doing well at that course of time. Now, what could be the objectives of doing this window dressing? First is to present better financial and liquidity position of the business by showing increase in revenue and profitability with healthy cash flow and working capital management. So as I said, there are several stakeholders who are looking onto your business, how your business is performing, how it is growing or not over the years, what is its revenue, its profitability. So in order to show that our business is doing quite well, it is growing, the revenue is nice, we are earning profit over the years, this window dressing is done. This is the basic and main objective of company doing window dressing. Now, second is to attract potential investor by overstating profitability of business and understating the liabilities. So also, if the company wants to raise money from the public, and those investors would be investing in that company only if they would be seeing the chances that the company would grow over time, and they would be paying back a good return on their investment, then only they invest in that company. So to show investors that the business is doing quite well, what companies do, they overstate their profitability by doing some kind of manipulation in the statements, and they understate their liabilities what they are having, so that the investors would get attracted towards the business position and they would invest in that company. Third is to avoid higher taxes to be paid on the income of business by showing low profits. Now, always it doesn't happen that the company is showing a better profitability. Sometimes the case is just reversed. The company also shows lower profitability by manipulating the data, and this is done to avoid the taxation, because the higher the profits, the income of the business, the higher would be the taxation by the government. And to show lower profits, companies sometimes avoid taxes by showing lower profits than actual. To avail credit and loan by banks or financial institution by showing a healthy financial with repayment capability. And this is also done because companies and businesses always need loans to continue their business, to continue their operational activities and some kind of expansion, any purchasing of machinery, and for various sort of financial need, companies approach bank. And to bank also do checking on the company's performance over the years, the business performance over the years, as well as the company's credit score. On the basis of that, the bank provide loan. So by showing that the business is doing quite well and it has the repayment capability by generating revenues and cash flows over the years, what companies want, they want to get the loan easily from the banks and financial institution as and when required. To increase the share value in market by attracting investor sentiment and to build up trust of stakeholders in the business performance. Also, as I said, it is to attract investor sentiments and to build up the trust of stakeholders in the business performance. So if you are showing a good profitability of business, if you are showing that your business is doing well over the years, it increases the share value of your company, which builds a reputation in the market, which also turns out to be positive for the company. So all these objectives are fulfilled through window dressing if the business is not doing well. This is done by the company. What could be the methods of window dressing? Now we looked at what is window dressing, what could be objective, why to do window dressing if it is not ethical, and why to do manipulation of data, because that could result into loss of trust from stakeholders. Why to do all those? We looked at the objective, why it is done, and now we can see what are the methods, how it is done. So these are very few methods. There could be a large number of methods by which manipulation is done in financial statements. So these are the most common one which could be identified, and you can probably identify those companies which are trying to manipulate the data and not get involved in their business and invest in that. So first is creation of secret reserve. Often secret reserves are created unnecessarily, which would not be published to lower down the profitability of business to avoid taxes. So what happens? Secret reserve is created. Okay, even if it is not required. Now, by creating reserve, you are lowering down your profitability, because some amount of money is going directly into the reserve. And by lowering down the profitability, what was your aim? It was to avoid the taxation by the government. If you are showing lower profitability, you would end up paying lower taxes. And if it was higher profitability, the taxation would be higher. So in order to avoid taxes, they create something called secret reserve, which they don't publish and use it to lower down the profits. Now, second could be showing contingent liabilities as actual liabilities. So showing contingent liabilities which are not certain, and which can happen, but unnecessarily you are showing that those contingent liabilities as actual liabilities, that they have happened. So in this way you are also trying to show more liability than actually it is. So this is also to lower down the profit and avoid the taxation. Third is undervaluation and overvaluation of inventories. Now, this is done to play with the revenue and profitability part of the financial statement to show higher or lower profit as and when required. So how this is done? Let's see. Undervaluation of opening inventory and overvaluation of closing inventory is done to show higher profits. So your opening stock, okay, inventory is stock which the company holds as in materials used for production process, or maybe the finished good materials, whatever stock is there. So if you are showing that your opening inventory was if you are undervaluing your opening inventory and you are overvaluing your closing inventory, your profits would be higher than actual. So this way, by showing higher profitability, you try to seek the attention of the stakeholders. Similarly, reverse way, it could be done that overvaluation of opening inventory and undervaluation of closing inventory to show lower profits than actual. Then there is switching to different methods of depreciation. When the financial statements need to be published right before 1 to 2 months before the publishing of financial statements, switching to different method of depreciation just to create more amount of depreciation as expense to lower down the profitability of the business is done. And then there could be selling of fixed assets. Now, when you have to publish your financial statements and a few months ago that you sell off any fixed asset and you get out the money out of it, the cash out of it, which shows that your business is doing well in working capital. Now you can position your business in that way, but that was not the actual position of working capital in your business. You just did something which was not useful for the business. You sell off the fixed asset, and that what created a better liquidity in the business. So this is also done many times to show that the liquidity position of the business is quite well and the cash flows is coming, working capital is manageable. Then postponing cash payment, this is also one of the window dressing method which is done. By postponing the cash payment, you try to again show the better liquidity in the business. So as we can see that window dressing methods are used for very various purposes, like to show higher profits or to avoid taxes, to show better working capital and liquidity management. So this is what we were discussing in the previous slides as well. This was all about this window dressing. Thank you for watching. I hope you like it. Do like and subscribe to my channel. Thank you all.